Every 18 years, the same pattern repeats. A housing market collapses. Then the dominoes fall. Most people think it was the oil crisis in 1972, the Soviet collapse in 1990, Lehman Brothers in 2008. They're all wrong. Housing crashes first. Everything else follows. Right now, the U.S. commercial real estate default rate sits at 11.8%. That's higher than the 11% peak we saw in 2012, 4 years after the financial crisis. Office vacancy rates have exploded to 20.7% nationally. In San Francisco and New York, 40% of CBD offices sit empty. The 2020 pandemic permanently changed how America works. Remote work isn't temporary, it's structural. Companies discovered they don't need expensive downtown real estate for Zoom meetings. AI eliminated jobs that once filled cubicles. The demand for office space has permanently contracted. But here's the critical part. This isn't about a bad economy where tenants can't afford rent. This is about tenants no longer needing the space at all. When offices sit vacant, landlords can't pay mortgages. Even when they find tenants, rental rates have collapsed. Supply and demand dictates pricing. When everyone's desperate to rent, rates were high. Now, landlords compete by slashing prices, creating a downward spiral. Each price cut forces the next landlord to go lower. The math breaks down completely. A landlord who once collected $1 million in annual rent to cover a $1 million mortgage now collects $500,000, if they're lucky enough to find a tenant. The bank still demands full payment. Every day becomes a bleeding wound, so landlords face three choices: drain savings to stay afloat, negotiate with banks for forbearance, or hand the keys back and walk away. Default. Default rates skyrocketing means banks can't recover their loans. When enough banks fail, the domino chain starts, just like 2008. But here's the strange part. Default rates started climbing in 2023. We're now in late 2025. No collapse yet. This is the terrifying nature of the 18-year cycle. The bomb is armed, but it hasn't detonated. The trigger comes in 2026. Commercial real estate prices have fallen for 3 consecutive years. JP Morgan estimates a $1 million office building from 2020 is worth $600,000 today, and they predict another 40% decline over the next 2 years. Meanwhile, interest rates jumped from 2 to 3% during the pandemic to 6 to 7% today. So why hasn't the crisis hit? Fixed-rate mortgages. During 2020-2021, the Federal Reserve slashed rates to near zero and flooded the market with money. Office prices soared. Landlords rushed to lock in 5 to 7 year loans at 2 to 3% interest, practically free money. Those contracts froze their repayment costs at the moment of signing. Even as property values crashed and rents halved, these landlords could grit their teeth and survive. Their locked-in rates gave them defensive capacity, like anesthesia, allowing them to endure the pain without selling. But all anesthesia has an expiration date. Unlike residential mortgages spread over 30 years, commercial real estate loans run just 5 to 10 years. Most are 5 years. The fixed-rate loans, signed in 2020-2021, mature between 2025-2027. The majority expire in 2026. Morgan Stanley and S&P both warn that at least $1.5 trillion commercial real estate debt comes due in the next 2 years. Here's what maturity means. You borrowed $1 million in 2021, paying only 2 to 3% interest for 5 years. After 5 years, you must repay not just interest but the entire $1 million principal. Most landlords don't have $1 million cash sitting around. Their buildings can't be sold. Values collapsed. So they refinance. Borrow $1 million in new debt from another bank to repay the old debt. 2026 triggers the nightmare cycle. Interest rates aren't 2-3% anymore. They've doubled to 6-7% or higher. Your building, that was worth $1 million now, appraises at $600,000. The bank might only lend $400,000, $500,000 against that collateral. You face doubled interest rates on half the loan amount you need. Impossible math. When default rates approach 12%, already exceeding 2008 levels, what happens in 2026 when thousands of landlords simultaneously hand their keys to banks? Banks transform from lenders into America's largest distressed property dealers and most unfortunate landlords. These buildings already failed because no one rented them. They can't be sold. Mass liquidation would crater prices further. But they bleed money daily through property management, maintenance, and property taxes. Banks are already responding in 2 ways: refusing to lend and aggressively collecting debts. Loan applications that once received warm welcomes now face suspicion. Will you be the next default? The lending bar has risen dramatically, starving the market of capital. Simultaneously, banks frantically recall outstanding loans, demanding repayment to shore up their own balance sheets. Small and medium enterprises dependent on bank credit collapse overnight, triggering the first wave of unemployment. A 20% average vacancy rate, 40% in major cities, represents more than empty buildings. Each office building supports an entire ecosystem: cleaners, security guards, baristas, convenience store workers, construction crews, decorators, designers, building material suppliers. All unemployed. Eventually, even government workers face layoffs. Commercial real estate collapse means property tax collapse, one of America's most important revenue sources. With the government claiming budget shortfalls, non-essential services get cut. The most important U.S. employment data, non-farm payrolls, confirms this. It's already collapsing. Unemployment is skyrocketing, and it spreads like contagion. Unemployment means no income. No income means no spending. Businesses can't make money and go bankrupt. One company fails, 100 people lose jobs. A vicious cycle. Act 5. The Fed's Trap. 7:15-18. You might think the Federal Reserve's interest rate cuts and pause on quantitative tightening will rescue the market. Lower rates mean cheaper refinancing, right? Wrong. The Fed cuts overnight rates between banks, short-term borrowing costs. Commercial real estate landlords need 5, 7, or 10-year money. Those long-term rates depend not on Fed policy, but on market supply and demand. Demand is exploding. Landlords with maturing 2021 loans all need refinancing simultaneously. More borrowers means higher rates. Supply is contracting. Banks have depleted emergency reserves. The Fed is stopping quantitative tightening, but with a twist. It's selling $2 trillion in mortgage-backed securities to buy Treasury bonds. This is critical. The Fed has always been the unconditional buyer of MBS, giving banks liquidity. Now it's not just stopping purchases, it's actively selling, draining $2 trillion from the mortgage market to prop up Treasury bonds. In 2026, refinancing demand surges while mortgage funding evaporates. The 6 to 7% rates today will likely spike again. Landlords who can't sell, can't rent, and can't afford the interest face only one option: mass default. The Fed lowered short-term rates, but mortgage rates are rising. The Fed stopped balance sheet reduction, but mortgage liquidity is tightening. This is the fuse that ignites the commercial real estate bomb in 2026. The 18-year cycle returns, and almost no one sees it coming.